Hello and welcome back to Chapter 11 Notes. And so in this lecture video we're going to talk about the volume variances, and we're going to do a comprehensive kind of overhead cost and overhead variance here, where we calculate the total overhead cost variance, and then we separate that into the volume variances and then the controllable variances. Okay? Before we do that problem, let me just kind of go over the basics here of the volume variance. That's going to occur when there's a difference between the actual volume of production and then the standard volume of production. So the volume variance is going to be the difference between the amount of overhead included in the flexible budget and then the amount of overhead applied using the standard overhead rate. And so the way we're going to calculate that is we're going to take our flexible budget level of overhead for the actual level of production minus the overhead applied to production using the predetermined overhead rate. Okay? So let's jump ahead right over here to looking at this problem here on page 26. Okay? So I want to look at this problem because this one we're going to go ahead and we're going to calculate the overall cost variance, and then we're going to separate that overall cost variance into a volume variance and a controllable variance, okay? So it really does a good problem of summarizing all the overhead variances, okay? So during November, our Heim company allocated overhead to products at the rate of $26 per hour. This was based upon 80% capacity. So remember what they actually had to do is, this is a predetermined overhead rate. It's an estimated overhead rate. So they have to first figure out what level of capacity do they think they're going to operate at. In this case, they chose 80%, and so that's what dictated how much overhead they thought they were going to have, and then, of course, how much allocation base, which in this case, the allocation base is their direct labor hours. So in that case, they said, well, we think we're going to have 1,600 direct labor hours. However, Heim Company operated at only 70% capacity, or 1,400 direct labor hours. So they only operated at 70% capacity. Budgeted overhead at 70% capacity is $38,900, and then actual overhead that they had for November was $38,000. Okay, what is the company's volume variance, and then indicate whether that volume variance is favorable or unfavorable. We're going to take this problem a little bit further, and we're going to calculate out the overall cost variance for the overhead cost variance, the total overhead cost variance, and they're going to separate that into the volume variance and then the controllable variance. Okay, so remember we have our OCV, which is going to be equal to our actual overhead minus the standard overhead applied. Okay, so we say our actual overhead, which is going to be equal to our $38,000. That's our actual overhead. That's given to me right over here. Now, how much overhead did they actually apply? Well, they applied it at $26 per hour, and remember they had 1,400 hours. So they took overhead, $26 per hour times the 1,400, which gives us our $36,400. And again, the way I did that was to take my $26 per hour times the 1,400 hours, and that gives us the $36,400. And when you do the math, you get a total overhead cost variance of $1,600, and that's going to be unfavorable because actual overhead is more than the total that was applied. So remember, the formula is to take the actual overhead minus the overhead that was applied during the accounting period. In this case, the total overhead that would have been applied is equal to the 26 hours times the 1,400 hours because they thought they were going to work 1,400 hours. Okay? So we come over here. Now we're going to separate this out into controllable and volume. Okay? So remember, with our controllable, we take the actual overhead minus the overhead that they should have had. Okay? So in the overhead that they should have had is how much overhead they should have had at the flexible level, the flexible budget level of actual performance. So their actual performance was 1,400 hours, right? So we can come over here and we can say their controllable variance, we're going to say the actual equals our 38, okay, 38,900, and then it says right over here, I'm sorry, the actual is 38,000, sorry, and then we don't even have to calculate out the flexible level, the overhead at the flexible budget level of actual performance, because it's given to us. It says budgeted total overhead at 70% capacity, which is what they actually operated at, is 38,900. So this is how much overhead they should have had. They should have had $38,900 in overhead, but they only had actual overhead of 38,000. So when you do the math, this gets 900 favorable. So I'm going to come over here and I'll put 900 favorable. Okay? Now you can back in to figure out what the volume variance is by you take the 1,600 unfavorable plus the 900, you know the volume is going to have to be equal to our 2,500 unfavorable, because 2,500 unfavorable minus 900 favorable would give you 1,600 unfavorable. But let's go through and actually verify that volume variance, okay? If we look back at our formula for our volume variance, sorry, let me find that. On page 17 right over here. It's the flexible budget level of overhead for the actual level of production minus the overhead applied to production using our predetermined overhead rate. Okay, so we say over here, we calculate our volume variance. And we're going to say our flexible budget level of overhead for the actual level of production is given to us right over here at 38,900. Okay, that's our flexible budget level of overhead for the actual level of production, 38,900. Now, how much overhead did they actually apply during the accounting period? Well, they applied 36,400. Remember that? Because they had $26 per labor hour times the 1,400 hours. Okay, that gives us this 36,400. Okay, so that is, if you look back at the formula, flexible budget level of overhead for the actual level of production is given to us at 38,900. That's right over here. That's given to us. And then our overhead applied, well, how much overhead did they apply? They had 1,400 hours at $26 an hour, 36,400. So now when you do the math, this gives you $2,500. And so you can see this is going to be an unfavorable, and it's unfavorable. It's unfavorable because the actual production is less than the planned production. Okay? Remember, the planned production was at 80% capacity, but actual is at 70% capacity. So now we can come over here and we can take our 2,500, okay, minus 2,500 unfavorable, minus our 900 favorable, gives us 1,600 unfavorable. Okay? So this is a really good problem to make sure that you understand, because it takes the overhead, the total overhead cost variance, and it calculates that, and then we go through and we separate that out into the controllable and then the volume, and we break it down. Okay? So continuing on with page 17, when we come back over here, when we talk about interpreting the controllable and then the volume variances, an unfavorable volume variance basically means that the company did not reach its desired operating level. So in that problem we just looked at, they operated at 70% capacity where they budgeted, they planned for 80% capacity. Okay? That simply means that the quantity of production was less than the anticipated level of production. So we would want to go through and figure out, well, why did we operate? Maybe there is a drop in demand for our products, or in what we're saying over here, it could have been poor economic conditions. Something else, perhaps outside employee control, caused that. Now the controllable variance This one gives us a little bit more information, in my opinion. Okay, so this says this is how much overhead you should have had. Right? You should have had this much. If you operated 70% capacity, you should have had this much overhead, and then you actually had this much. What happened? And if it's unfavorable, it's going to be due to poor cost control. If it's favorable, then you had good cost control. Okay. Now, what I'm saying right over here, we would want to probably break that controllable variance down into a little bit more detail. Maybe we could look at indirect materials. Okay. Actual indirect materials cost to how much indirect materials should we have had, and then actual other components of our. We could compare our actual direct labor to how much we should have had, okay? And then our actual fixed costs to how much fixed costs did we actually have, right? So those are how we want to break that down to figure out, well, what is the true cause? What are the underlying causes of that controllable variance? When we talk about investigating our standard cost variances, sometimes they can be reported too late to be useful. If it's used as a tool for punishing people, the standards can undermine morale. I'm sure that they can, but on the other hand, this is going to be done. Okay. What I say over here, just meeting standards may not be sufficient. You want to have continuous improvement. So you might want to revisit those standard costs. Okay. I would view these as an indicator of potential problem areas, and you want to investigate the facts behind those variances. We've talked about management by exception in the past. Investigation of these cost variances is a time-intensive and costly activity. So you want to only consider those variances that are large, that are exceptional, maybe in terms of percentage or absolute dollar variances. We say right over here, a variance that is favorable should not be exempt from investigation. We had that example before where we had that favorable price variance, but that favorable direct materials price variance, but that resulted in an unfavorable direct materials quantity variance because they used low, or they could have used low quality raw materials. Okay. So we say over here, can process improvements lead to unfavorable variances? And so we say over here, process improvements can lead to greater efficiency in the production. Okay. That would make sense. Greater efficiency could result in actual labor hours being less than the standard labor hours. So, for example, a company requires 4 hours to make one unit, and they make 500 units. That implies 2,000 labor hours, 500 times 4. Now, suppose that the company improves the manufacturing process. As a result, the company can produce with only 3 hours. That implies that they will use 1,500 hours. If the company doesn't lay off workers, though, there'll still be 2,000 labor hours. So we're assuming basically if they can't reduce the labor, right? Maybe because of a union situation, even though you have this process improvement, it doesn't help you. Okay? We say the last thing over here, when bottlenecks exist, the department and the bottleneck should not produce more than the bottleneck department can handle. If it does, it'll create excess work in process inventories. Okay. I'll let you go over this example here in a little bit more detail by reading it. And then finally, we do have some responsibility accounting and variances. We want to only hold those managers responsible for the costs that they can control. If it's outside their control, it's not fair to hold them accountable. I do have some additional problems right over here on page 11. I have posted the solutions to these problems up on Canvas. I encourage you to do these. Okay, and this one as well on page 23. This one on page 24. And this is a controllable variance problem that's on page 25. And all the solutions to all these have been posted up on Canvas. Okay. That concludes the Chapter 11 lecture videos. Thank you so much.